So everybody that's joining us this evening, welcome to the StrataVentures Monday Night Industry Webinar. We're always bringing great value to our investor industry, and most of all know that StrataVentures is a team built by investors for investors. So every Monday, we bring key speakers that are here to earn their business and also, most of all, educate everybody on the very important factors or bits of information within our business. So at 6:30, we have our welcome here. At 6:35, we're going to go into the guest intro and then a Q&A session if you'd like to have your Q&A session now, or have an attendee Q&A session. And then we'll go ahead and open up your presentation there. So for everybody that is joining us, if you've never used Zoom, there's a lot of buttons down at the bottom of your Zoom window. And your two primary ones are obviously your mute and your stop video, but because it is a webinar session, you guys won't be able to use those buttons. But the ones you'll primarily want to use is your Q&A. Please, we encourage that you guys ask questions, because the more information or questions you ask our speaker, the better they can actually inform you. Take advantage of this time here, guys. If you want to chat with the moderator, we have two moderators. Right now we've got Oriana Ovalles, and we also have Enid Lopez. So feel free to send comments. And most of all, know that if you do want to leave the webinar because Diego or Julian bore you, go ahead and hit the end button. But no, I think we always try to have fun at these webinars, guys. Now, to get to know SVI, if you go to www.investorrealestatetraining.com, you can see our new landing page, and also register for a free one-on-one training session there in order for you guys to know exactly what SVI is, how we can help you. But most of all, if you decide to work with us, awesome. If you don't, at least you're going to be leaving with a ton of information that's definitely going to help you in your investing career. And about our speaker here. So let's see here, Julian. You migrated to the US in 1986, correct?
That is right.
All right. And what nationality? Where are you from?
I was born in Colombia, in South America.
All right. And so your wife, Claudia Garces, is a petroleum engineer. And in December of 2012, you guys have got twins, right?
Yes, we do. Here, you can see them. This is when they were a little younger, back there, or here.
Oh, okay.
They're 7.5. They'll be 8 years old in December.
Is that the sounds in the background?
Yes.
Okay. All right. I guess everybody in business now has to get used to those sounds in the background where you can't really quiet the kids because they're now a part of your day-to-day life.
Nonstop.
Yep. You went to the University of Houston and you obtained a certification in entrepreneurship from the Bauer College of Business. And then you began in the mortgage industry in May of 1998. I'm very familiar with the mortgage industry, especially back in those days where the mortgage industry was exploding. And obviously that ran for a good 10 years until we all know what happened in the duration of the mortgage crisis.
Right.
So your company or your brokerage joined with Alterra Homes in early of 2020. And tell me a little bit, what was the decisioning behind moving from one outfit to the other or merging with another larger organization?
It was a series of factors, I believe. I could tell you two main ones was just the ability to grow. I felt like we didn't have that. We needed access to more capital in order to expand into other markets that we're not into, or that I'm not into, my team. So that was one thing. And the other thing too was the availability of product, or a product line, right? Prior to coming to Alterra, we had a very plain Jane vanilla type loan program menu. And so in coming to Alterra, the appetite for more variety of lending is here. And sure enough, I mean, we're closing more business this year than we did last year. Some of those factors are natural because of the low interest rates that we're living, but also the purchase business, which is our focus, has always been my focus, is purchase business. So we're doing more purchases than we did before, just because we have a more ample line of product with Alterra Home Loans. And so, yeah, that those are, I'd say, two main ones that made the decision.
And definitely I can vouch for that. Julian, you helped us on the sale of our last property. And then you also helped us on the purchase of the current one that we're in, and also a refinance. And so we've always, I mean, you passed the smell test with my wife. And so,
Thank goodness.
oh yeah, that was pretty tough there, but definitely, you guys, Julian is a vast, he has vast knowledge and a lot of experience in this business. So with that said, one of the main topics, the key points of presentation, correct me if I'm wrong here, is going to be the difference between a conventional loan and a private or hard money loan. Also understanding what does a conventional loan require for a property to be accepted, which is huge. You know, that's very important. And also what to have ready when requesting a conventional mortgage loan, which I'm assuming it's going to be considered in our industry the language of what we call a takeout loan. You know, a takeout loan is to refinance from some of the expensive capital we use in order to go into something more conventional.
Yes, Diego, we're gonna hit on a lot of different points as I go through my presentation.
Mm-hmm.
And then at the end, we will have a Q&A. I find that normally the Q&A sessions are the most valuable whenever I'm doing any type of group meeting or speaking to a group of people, because those questions feed into other questions that people have or things they haven't talked about. So I will try and leave as much available time for that, because I find that to be the most enriching part of the presentations when we do them.
Absolutely. So with that, Julian, go ahead, take it away. I think you've got the authorization to share.
Okay, sir.
And everybody that's joining us, feel free to input your information in the Q&A section, and we will be able to moderate that over here for you.
Thank you. And then for the Q&A, will y'all be gathering those questions and feeding them to me?
Yep.
So that I can, okay, good, awesome.
Absolutely.
That'll make it much more easy to handle and focus on the presentation or the material that I'm talking about. Okay, wonderful. Let me share my screen with y'all here.
Julian. Let's see, there you go.
Oh, it took me out. There.
Okay, now you need to be able to share.
Mm-hmm. All right, just give me a sec. Because I have multiple screens, and so if I try to share while the multiple screens are connected, it makes a mess out of this. So I took them off, and I'm just on my direct computer here. Give me 1 second. Let me go and make sure to set up the presentation. Okay, here it is. Yep.
And you let me know during the presentation, a spot check to see if we have any questions in queue and we can answer them at that point, or if you'd like, you know, later on further in the Q&A section.
All right, so here we go.
Let's see, I think we've got, there we go, Julie. All right.
You got it?
Yes, sir, go ahead.
All right, well, thank you, Diego. Thank you to all the StrataVenture students that are here and all of our visitors that are interested in real estate investing. I think this is going to be very helpful to all of you. Obviously, time doesn't permit for us to do a 1,000-meter dive into all this stuff, but if the public demands it, Diego, we could put together more thorough and more specific training in any of the things that I'm going to go over as I speak with you all today. And as I mentioned at the end, we'll open it up for Q&A. So please save your questions for the end so I can get through everything. And make sure to ask stuff. If you don't ask stuff, I'm going to start asking my own questions. Okay. So just a little bit more about what Diego already started. 22 years in the industry. Diego and I actually go way back. We met right around 1998 when we used to work for Bank United here of Texas. It used to be a pretty good sized bank that had offices all throughout the state of Texas, and they were absorbed by Washington Mutual, at which point Everybody split, right? Because they let everybody go once that merger took place. And Diego and I stayed closely friends all throughout this time. I was actually a part of Diego's first SBI venture class. So I was like, would you consider me like the first graduating class,
I would
Diego?
say so, yeah.
Right? So I'm familiar with the program. I'm an investor. My wife and I have five properties, you know, and so we're familiar and we understand what investors go through. We understand what needs to take place. Obviously, we don't know every single thing there is to know about it because it's a lifelong learning process. But when we're working with investors, we certainly know how to just not do a deal for them, but also add some value in sharing our experiences or giving them our opinion and recommendation on those decisions when involving with investments. My passion is to help people obtain the keys to that house, whether it's a homeowner that we're helping buy a home for the first time, whether it's a family that's moving up because they've been in their house long enough. And that's something that's really cool that we've been doing a lot of in the last few years, Diego, is we're actually teaching homeowners that have been in their home for a while now how to convert those into rental properties and upgrade into a new primary, and then keep doing that every so often so they can build themselves 3, 4, 5 homes over the course of their life and end up with a few retirement homes by the time they retire. So Move Up Buyer and Investors has become a really big part of our practice, and we enjoy it extremely. But today I get the great honor of going over with you what is the difference on conventional loans. So and this is going to be very lean towards identifying the differences between like a hard money or a private money loan versus a conventional loan, right? Because I'm a strong believer that as a investor, we need all the lines of financing that are available. There is no good or bad. There's simply products that are needed for the type of transactions that we need to engage in, okay? Whereas your private money, and this sort of is the pictorial vision of the difference between a conventional hard money loan, a private money loan, for the most part. I'm not saying it's every single time, but for the most part, right? We think of private money loans or hard money loans for the loans that we need to acquire a property, fix it up, get it in top shape in order for that property to qualify for conventional financing, okay? So we will focus the conversation practically on that area of the difference of the two types of financing. Now, how are they different though? When we get to the nitty-gritty of it, how are they different? Okay, conventional loans are your long-term holding money. Diego called it a takeout loan. Yes, so you take it out and you're going to hold on to it for a while. So these types of loans are used for you to acquire rental property or hold on to your rehabs for long-term payback. Yeah. And these are the types of loans that for the most part, your buyers are going to obtain when purchasing property from you if you've done a rehab project, flip project, something like that. So it's very important to understand it, not just for yourself, but also for when you go sell the property, right? If you're not sure or you don't understand how these programs work, it could be painful. It could be a painful process. So we'll talk about that. Conventional loans offer current market interest rates, currently near 3% for a 30-year fixed rate mortgage for an investor, right? For homeowners, it's actually less than 3% right now. This in comparison to private money or hard money lenders, whatever they charge, right? Diego, and you know more than I do about this. What is the average going rate for private money or hard money loan right now?
Let's see, your hard money lenders are going to range anywhere depending on obviously volume, can go anywhere from about a 9% to 14%, and the ranges between 2 to 4% on points and fees. And then on your private money lenders are averaging around 10% annual
Okay.
for those
So
loans.
it's definitely not an interest rate for someone to be profitable on a rental long term, or feasibly hold on to that property financially speaking for a long term.
Correct. It's a short term. It's an ability to obtain quick capital in order to be in and out of that funding within probably no more than 6 to 7 months.
I like to look at those types of loans as a opportunity loan, right? It's a loan that helps you capitalize on a opportunity when it comes to real estate. So I strongly believe in them. I just know that you can't hold on to those long term. So start thinking about that as the difference of like, okay, when does each one come into play? Conventional loans do require the property to be in habitable conditions. And that's when we're gonna like start splitting it up. Very important to understand that. So they do have stricter appraisal requirements when qualifying for those, when compared to a hard money or a private money loan. And at the end, we'll talk about what specifically they're looking for, the difference, right? But for the most part, when I talk to people, I like to say the property has to be in habitable condition. So what does that mean? Well, you got to have toilets, you got to have bathtubs, you got to have a kitchen with all the cabinets, right? You got to have hard floors. You can't have busted up walls. You got to have a roof. You got to have climate control systems. Anywhere where somebody would have to go in there and live, they could without running a life risk, right? Now, it's important to understand this because it comes up a lot. The property doesn't have to be beautiful. So, I mean, it could be a house that just hasn't had any upgrading in 40, 50 years. As long as it's functional, it will qualify for a conventional loan, right? So if it has wallpaper back from the 1940s, or a layout that's just not common in today's, in today's market, that's okay. As long as it's got all the functionalities for somebody to live there, that property will qualify for a conventional loan. Most of the financial qualifications for a conventional loan, most of the weight for the financial qualification is going to be placed on the individual rather than the property, right? Although they both will come into play, at the end of the day, a conventional loan is being done to the investor, to the person, to the buyer, if it's the end user. It's not being done for the profitability or the rental cash flow that the property is going to yield, right? At the end of the day, if the property is not rented or what have you, the owner, the investor, the person that took out the loan has to be responsible for the payback of that loan. And so the financial profile, the credit profile of the person is going to be, it's going to weigh heavily in that qualification process. Okay. And then just a little bit more about that. Understanding conventional loans and preparing for conventional loans. So organization is key, right? Especially as investors that we've got projects going on. We're spending money on supplies and materials and contractors. So making sure to keep organized folders. And I remember very well when you went over it in class, Diego, is have folders for each of the properties, right? Make sure to save the pictures and save the receipts and save the contracts and save everything in a very organized fashion, because conventional requirements are going to ask for a lot of documentation. So it's very helpful when you have it organized and neat and readily available. You're going to be asked to present receipts for what you spend on the rehab, if it's a rehab project, right? To justify the increase in property value from where you bought it to where the property is now worth, right? So I see investors struggle with this a lot, Diego. They bought a house, I don't know, just to give an example, they bought a house at 120,000 and now it's valued at 180, 190. Well, underwriters are gonna want to know, like, how did that property become so much more valuable in such a small amount of time? And investors get upset because they think that the underwriters are questioning how they're making the profit, right? And that's really not it. What they're wanting to know that there's no funny business going on. They're wanting to know that the investor actually like put in some work to make that house worth what now they're selling it at, or what they're wanting it to appraise for in order to cash out or refinance it at. And the only time that I ever see people struggle or get upset about it is if they don't have that information readily available, right? If they don't have a tally and the copies of the receipts. It's really simple. Like they just have to make like a worksheet of the things that went into the property, right? And that'll be it. I'm busy right now. I'll tell you later. I'm busy. I'm doing a presentation. There's your home work moment of the day. All right. So moving on, guys. Avoid having the property appraised for a conventional loan if it's not ready. If it's not completed, avoid doing an appraisal on it, right? It's going to raise more questions, more red flags, more scrutiny if the appraiser goes in there without the property being ready. And that comes up whenever either home buyers or investors are they're wanting the deal to hurry, right? They're wanting to accelerate the deal, so they want the appraisal to take place. They want a subject to appraisal. I don't recommend it. We can start the loan process prior to the appraisal being done. I just don't recommend the appraisal being done before the house is actually completed, so that report doesn't have any, verbiage that there's stuff missing or what is needed, that they're going to have to come back and check it out. So I like to avoid final appraisals is what I'm trying to say. It also creates more closing costs whenever you have to have the appraiser go back multiple times to the property to see if it's gotten completed. You'll be able to finance 80% of the current market value for a property, or ARV that you might call it. So you can ask for an 80% loan on a property, an investor loan on a property, if you're buying it or if you're paying off another loan or another lender, okay? Up to 80%. If you're cashing out of an investment property, then the max you will be able to cash out is 75% of the current market value for that property, okay? Now, really important to understand this. If you're cashing out of a recently acquired property, so I'll give you an example, Diego. Let's say you bought a house for $100,000 cash, right? You pumped in 20 grand. Now the house is worth 200,000. You want to borrow 75% of the value on that house 3 months after you bought it. Well, if you haven't owned the property for at least 6 months, you're not going to be able to use the current market value on the house. You're going to only be able to use the value of what your acquisition cost was. So what I recommend is hold off for 6 months before you request a cash out loan, so that you can cash out on current market value and not on acquisition value. I hope that makes sense.
Pretty much 6 months seasoning.
6 months seasoning on title. Right.
Mm-hmm.
Right. So that's really important to understand, especially when you're dealing with investors and stuff, right? Because you have to create realistic timetables for when they're going to get their money back, or when you're going to exit, if you're going to cash out and return everybody's money and keep it as a rental long term. Yeah. I think it's a great way to acquire property for people that can't afford to do it on cash and then just pull it back out. Because normally you're not going to finance, or you shouldn't finance more than, we learned this through the center, more than 75%, right? We shouldn't pay more than 75% of what the AR value is going to be when the house is ready to go. So it's sort of like coming back to that percentage. So I enjoy those really, I enjoy those a lot, very much. Make sure to file rental income on your income taxes. Oh my gosh. It's incredible how many people just don't file their rental income for the rent. And so what happens is you might be able to get away on your first acquisition, maybe your second, if you do it within a year, both. But once the years start going by, if you don't have a record of how much your rentals are making, they're not going to keep lending you money on it. Because at the end of the day, remember what I said earlier, at the end of the day, the loan is given to the individual. So if the individual can't show that they're bringing in money from the properties, either their personal income has to be so strong as to support the payment, the carrying cost of those mortgages, taxes, insurance on the rentals that they have, or they have to show rental income to at least show that they're paying themselves and that they have the personal capacity to borrow for another house, right? So even if it's not filing any earnings or any profits from the rental, it's just breaking even is fine. What underwriters don't want to see is that people are losing money on their rental properties, because that means that their personal income has to carry those rentals, because there's no other income, right? Like that's where it's going to come from. So make sure to file income tax with rental property income.
So Julian, when somebody is applying obviously for another property and another property and another property, is 100% of the positive cash flow considered towards the debt to income ratio, or is there a percentage of that it's considered? And the asset pulls this amount, and then your own personal income strength pulls the remaining balance. Is there a difference there?
Right. So in most cases, the underwriters will give the investor credit for 75% of the gross rental income for the property. So in other words, they're going to reduce that rent by 25% to consider for vacancy, consider for repairs, yearly repairs, upkeep, that kind of stuff. So if your rental income is $1,000, the underwriter is going to give you credit for $750. They're going to leave that 25%, right? And so the important thing is to show that the property is at least going to net the 75% that the underwriter is going to hit you up with. And that's sort of a difficult calculation. I would certainly discuss it with the loan officer. We hope it's us. To tell you, okay, the property needs to be renting for this much in order for the numbers to work out. And does that really play out? Like, is that really current market rate for a rental that you're looking at, right? And like I said, if the personal income of the individual is strong enough, it can carry the difference, right? If there's a few $100s difference or whatever on that 75%, the investor can certainly carry it with their own personal income if they have personal income, right? Keep a conventional loan pre-approval on file with your lender so you can pull the trigger anytime a deal comes up. That is huge.
Yes.
And a lot of people don't understand. Like, there will be times when you will find a great deal, and great deals, they don't last, right? So if you have to like go apply for a loan and turn in your income taxes and all that, by the time you get pre-approved, that house is gone. Like, it ain't waiting. So we have multiple investors that have pre-approvals on file. All they do is call us, hey, I'm making an offer, I need a pre-approval. Boom, within minutes they have it, right?
Absolutely.
It gives them that purchasing power. And that is something that you need to demand of your buyers as well. When you go sell investment property or rehab, whatever, you need to demand that they show you that they have been pre-approved, so that you're not tying that house up on anybody that just liked your house but hasn't gone through the process of really establishing if they can get the money or not. It's important. Time is money, right? It's what it's all about in my book.
And you guys can lend on a national level, correct? Is that my understanding?
Yes, we can lend in 38 states. We're not in every single state, and I can show you where those are here at the end of our presentation. But yeah, we cover a pretty large footprint in the United States.
Awesome.
So what do I need to have to apply for a conventional loan as an investor? So here we go. This is what we need to have ready. And then we're going to talk about how do we apply. So income taxes, have your income tax up to date. If you don't have your income taxes up to date, it's really difficult, because if you owe taxes and the IRS gets hold that you have a house, they're going to come lien that house on taxes. So lenders don't want to put you in that position, because it ties up their title, it ties you up, right? So income taxes need to be up to date. Last 2 years of income taxes filed, and make sure that you have copies of everything. I recommend you keep electronic copies at all time. Like we have a folder where we keep all the taxes for every year. Whenever we need it for whatever reason, we shoot it out instantly, right? It's readily available. So have those ready. Uh, Proof of current income. So if somebody is a W-2 employee, right, then we're going to want to see pay stubs for the last 30 days worth of pay or worth of work. So 30 days pay stubs if you're a W-2 employee. If you're self-employed, a contractor, you don't get a W-2 form, then we're going to want to see a profit and loss. Profit and loss from January 1st up until, the last completed month of the year, at this point in time being August. So profit and loss from January 1st until August 31st, 2020. Yeah. So the profit and loss for a self-employed person works sort of like the year-to-date pay stub for a W-2 employee. Now, it's really important to understand the weight of the income is going to come from previous year's income taxes. The P&L is more of a formality. The underwriters are not going to give you credit for that income that you're showing on the profit and loss. They just want to see that the business is not going under by showing no profit and a bunch of losses in the year 2020, as an example. So this is really important. For people that want to start investing or that are getting ready to become investors, it's extremely important that they have those income taxes checked out by a loan officer so that they can start helping them prepare for future income taxes so they're filed properly in the event that their past income taxes haven't been very strong. That is huge. And we do tons of work with business owners, whether they're buying their home or they're investing, in advising them on their income taxes so they can file proper amounts or the right amounts, or just file the right sections, right? Because as self-employed borrowers, we don't just look at the net income. We actually look at mileage. How much mileage are they writing off? That we make that into income. How much depreciation are they writing off? We convert that into income. And that goes as well for houses. One thing would be really good, Diego, is for us to do a class on how conventional lenders qualify income for rental properties.
Absolutely. I believe that
pretty awesome.
I believe that is definitely something that we can do. And most of all, while the members are going through the curriculum, one of the biggest things that we tell them is to contact their vendors, their SVI approved vendors, because it's about positioning yourself correctly on the right path. If you're new, you need to start thinking now, not a year later and then figure out you're a year behind on showing income or profit and loss or organization.
Right.
So this is great information, guys.
When that opportunity comes up, that shows up, knocks on your door, if you're not ready to go, you won't be able to move on it. So that's something we'll gladly do for SVI students. Okay, last 2 months bank statements. Let's talk about assets a little bit, which is really important. So last 2 months bank statements or statements from any account where you store money that you're going to use to purchase the home, right? So here's the thing with investment properties, you're going to be asked to have to show proof of that money for the last 60 days. So if you haven't had it in the account for the last 60 days, you're going to have to show proof where it came from. If it's a sale of an asset, that's fine. If it's money that you liquidated from a fund or an investment account, retirement account, that's fine, as long as it's your money. What's not permitted is gifts. So like, say you and your brother are in business and you're going to take out the loan, but your brother's going to give you the money for the house, but they're not going to go on the loan. Well, that's considered a gift, and gifts are not allowed on conventional loans when purchasing investment property, which is something that's very different from private money or hard money loans. All they care to know is that you have the money under your possession. Conventional loans, not so much. They're gonna scrutinize where the money's coming from, okay? So if at anything, because I know a lot of people don't like to have money just sitting in the bank account doing nothing, right? So at the very minimum, like have it in an investment account, even if it's like a money market account, but have it under your name where you can tap into it anytime you need, liquidate that to use it towards the closing on the conventional loan. I see a lot of investors struggle with that because they don't have the money ready to go. It's under the brother's name or somebody else, right? It's going to give it to them. Really important. Have your IDs, social security cards if you're a U.S. citizen. If you're a U.S. resident, have a non-expired U.S. residency card. And for those that are, on some type of transitional status, they're applying for a permanent status or what have you, their employment authorization document to show that they can legally work in the United States, that they can legally borrow in the United States. Okay.
And Julian, we do have a question in regards to that here. It says, can you apply for a convention? And this is from Ayush Gupta. Thank you for asking that question. Can you apply for a conventional loan if you don't have an EAD, but have an H-1B visa?
Yes, you can.
All right. And Mr. Gupta or Mr. and Mrs. Gupta, if you guys, your information is in the registration and Julian will be able to chat with you guys.
Wonderful. Okay. And then the last thing is share some basic information with us, right? Like your name, your date of birth, where do you live, how long you've been there, where do you work, what's your position, that sort of stuff that comes on the loan application itself, which is basically our next step. How to apply for one of these conventional loans, right? Pretty simple. 3 different ways to apply. We're looking for other easy ways to apply as well. We're still looking, Diego. So you can call us, right? You can call us. We'll take the information over the phone. It's basically an interview, get to know you a little bit, and record all that information in our system so we can open you a file and start processing your loan. You can also do it through our online portal, julianvasquezteam.com. You click on the apply button and you're off to applying. Our portal is extremely secure. It will ask you to create a login and password so you can go in there and go back anytime you need to, or if you don't have a chance to complete the loan application in one shot. By the way, our portal will also allow you to upload your income taxes and your ID and your bank statements, all that stuff. And then the last way, which is very, very popular nowadays, is through our Pronto phone app. So if you should be able to put your camera over this barcode thing and it should take you to our webpage where you can download our phone app. Our phone app is marvelous because not only does it allow you to apply for the loan online, but also it allows you to use the camera of your phone as a scanner so you can take pictures of your documents and scan them straight into your file.
That's awesome.
Yeah, it's pretty amazing.
Oh man, that's awesome.
Enjoy that.
Processors have got to love that.
They do. It simplifies the process. We see that clients enjoy it a lot, and at any moment we ask for anything, they just go back in, open the app, take more pictures, and send it to us, Okay. So this opens it up. This leads us to our final section. I think we're doing pretty good on time, Diego.
Yeah, absolutely. We do have some questions here.
Wonderful.
So let's see here. Gloria Nasike asked, why are W-2 business owners not treated as employees and have to provide a P&L, tax record, etc. for the company?
That's a very good question. It's a very interesting question. And for many years, I asked myself the same thing. So here's the reason. And I believe that she's referring to business owners that pay themselves W-2s, right, from the business. And she's asking, why are they not treated as a regular employee? Why are they subject to more scrutiny and presenting more information about their business? Mm-hmm. So the reality is, if a business owner's income derives from a business, they need to show that business is doing well, that it's in healthy financial shape, because if the business shows that it's going under, guess what's going to happen to the business owner's income too, right? It's going to go under. So that's the main reason why underwriters are going to ask for corporate income taxes and a lot of other things from the business owner. They just want to make sure that the business is in good financial shape, because ultimately, if that business doesn't work, then it cannot pay its business owners. So, so having mentioned that, and I'm so glad you did, it's so important to work with a lender that understands business owners, that has ample experience working with them. You know, I take in so many cases. Last week, I took a case where the lady wants to buy this house. She's a business owner, successful business. I mean, 700,000+ gross income a year. But in the way they were reporting their income tax, it showed like they were losing money, right? And that is simply a mistake on behalf of their tax preparer that didn't file the way they should have. So yeah, even though they have W-2 income, the business showed some major losses. So on paper, it looks like if that business is not going to be able to survive 2020, right? So unfortunately, I had to tell them, like, you're going to have to wait until next year when you file your 2020 income tax, and then you're going to have to show like some good activity, where at the very minimum, make it look like 2018, because if you'd filed 2019 like 2018, you would have qualified.
That makes sense. So let's see, let me ask this question right here. Mr. Larry Hayden asks, can you consider funds in your self-directed IRA, like having personal funds in your savings account with a bank?
Yes, absolutely. Is that IRA, if the IRA is under your name, yes. Or if you're the owner of the IRAs, absolutely. Any investment accounts that are yours, if you choose to liquidate them, no, those are your funds. That's fine.
Excellent. Good question there, Mr. Larry. And Ramon asks, how long do you need to be renting a property in order to take rental as income?
So, great question, by the way. That is a great question. Okay, so check this out. This is really important. Y'all need to pay close attention to this, because this is a loophole that you can take advantage of. And we need a lot of loopholes if you're investing.
Yes.
All right. So what the separator with the rental income is the income tax, okay? So if you bought a rental property in 2019, that property should have shown up in the income taxes for 2019. Now, if you bought the house in 2020, we have not had to file income taxes in 2020. So all the underwriters can go off of in that case is whatever your lease agreement says that you're taking in. And if they want to get really, really sniffy about it, they'll ask to show your bank deposits where the money's coming in for the rents, right? So you don't have to have that 2020 acquisition in any type of income tax, because it doesn't exist yet, right? And I think that's, and then even in 2021, that house is not going to show up anywhere until you actually file your income taxes for 2020. Okay. So that's the loophole. And this is what I would recommend. Postpone filing your income taxes for as long as you can, so you can buy as many houses as possible without having to show them on your income tax. So think of it that way. I buy the house, and when I file the income tax for the year that I bought that house, that's when it's going to have to show up in my income taxes.
All right. Good question. We had a question here. Jude asked, how long do you need to own a business before the business income can be used?
And who was that asked the question, Diego?
His name is Jude Dowdu.
Jude, good question. So Jude, for the most part, they're going to ask business owners, self-employed borrowers to show a 2-year income tax filing. So your business can show a 2-year back-to-back history. That's sort of the standard requirement. Now, there is exceptions to that, or there are exceptions to that. And here's the most common one. If your business has been in existence for over 5 years, okay? You've been self-employed over 5 years, or your business has been filing income taxes for over 5 years, and your credit score is over 700, we have a program where we're only asked for the last year income tax, so 1 year income tax. Okay. This helps people, so many people, Diego, because for the most part, it's a struggle. Like I've been there. I think you've been there, where you're trying to tame the IRS beast, right? If you file too much money, they'll chop your head off in income taxes. So you're trying to file enough to where you show you're making some money, and not lose an eyeball in taxes. So this program helps so many people because so many of them they don't file enough income over the years, but if they've been self-employed, they just have to have one really good year that they can qualify for. So when they consult with us, we tell them, hey, look, next year, this is what you're going to have to do to file on your income tax in order to qualify for the properties that you want to qualify for, right? Or the investments that you want to qualify for, whatever. So that is a great opportunity for folks that have been in business for over 5 years and have really excellent credit scores. But falling behind that is your traditional formula is going to require your most recent 2 years income taxes. The underwriters are going to calculate income from both those years. They're going to average it across 24 months. Okay.
Okay. So we got another one here. Let's see here. Okay, I got a question here through the chat. Is if I'm an investor and I'm selling the property to an FHA buyer, am I required to do the repairs before accepting an offer or getting it funded?
You're not required. I was hoping nobody would ask about FHA loans, but now that you did,
I knew it was coming up.
Now that you did, Diego, we're gonna have to do a session on FHA loans. Yeah. But thank you so much. This is why I love Q&A, guys, because it's so darn awesome. So many great things come out of it. So if you accept an offer for your FHA property and your property needs repairs, you don't have to have them done by the time you accept the offer, right? You could put the house under contract prior to the repairs being done, but they will have to be done prior to closing. It will have to be done prior to closing. Now, okay, if you go back to what I said earlier about the property being in habitable condition, right? We don't go off of the property inspections. We don't go off the inspector report. We go off of whatever the appraiser says. Matter of fact, we don't even look at inspections. We don't want to see inspections. We only are going to go by whatever the appraiser says. So only if the appraiser notates that something needs to be corrected in the property, our underwriters or conventional underwriters or FHA underwriters going to say, hey, this needs to be fixed before we can go to funding, right? And then you can literally go all the way to the day before funding. Like everything could be ready to go if you just don't want to make these repairs, because you want to make sure those people are ready to buy your house before you go put the money or the effort into it. Then you just got to make sure that it's done at least one day before the closing so that the appraiser can go back out there, check off his list that the stuff got done, and send the certification to the lender saying, hey, the stuff I said at the beginning when I came here at the first time has been done. The house is ready to go.
Let's see here. Another question is there a maximum loan amount your company lends, or what are the lending limitations right now?
Really good question. So the current conventional loan limit is at $510,400. That would be the maximum loan amount that we would do. Now, in situations, and they don't so much apply for investor type opportunities, unless you're just like doing $1 million deals and you're rehabbing them or something like that. If that becomes the case, then we can look at doing a combination type loan where we'll underwrite a $510,400 conventional loan, and we'll get a outside investor or lender to lend $200,000, $300,000 on top of our $500,000.
Okay. So there was a question here. Miss Angie Hudson asked, how many conventional investor loans can you have if you have a large enough income to support additional loans?
Good question. So the Answer is you can have up to 10 residential home loans outstanding. At that point, you meet the cap for conventional lending. So listen carefully to what I said. I said loans, right? I didn't say properties. So you can have 20 properties. As long as more than 10 of those are not under a mortgage, you can keep borrowing. So you can have 15 paid off houses, and you could have 5 homes being financed. Well, that means you can finance another 5 and still be under 10 financed properties. So that would put you like at what? How many loans? 25 deals, 25 houses?
Yep.
Okay. So the rule is not to have more than 10 financed properties. You know, and then once you exceed that 10 finance threshold, then, you know, you go into other territories where you have blanket loans and stuff that like it covers all the loans, and then you just have one big loan for all the properties, right? And that'd be a class for a different teacher.
That's walk into your local bank.
Right.
Your VP of conventional lending can help you there. Ayush Gupta asked, not sure if this is the correct question for Julian. If I'm buying a house in an FHA loan, does the lender allow me to put the property under an LLC?
Wonderful question. So first of all, FHA loans are only for primary usage or owner-occupied properties. So as an investor, FHA doesn't have a program to fund you to buy investment homes. Okay. Neither does VA or USDA. Those are all government type programs, are only meant for you to buy a house to live in. Now, they don't say that, hey, once you buy the house and you live in it, you can't turn it into a investment property or a rental home. Okay. So many people buy their first home with one of those programs, and then they make that a rental and go buy them another home down the road, which is kind of like the lines of the stuff that I'm teaching now, Diego, is have home buyers go in, buy a home at a modest price, and then in a few years from now, go back and buy another home with a really low down payment, make their first a rental, they got a second one, and a few years later, go back and do it again. Now they have 2 rentals and a new house and so forth. So that's really important to understand. Government type loans are only owner occupied type properties. They're not for investment properties. And there was something else. Gosh, I was about to say something else and it escaped my mind right now.
Under a conventional and even an FHA loan, if you are moving from one property to the other, what follows you is your homestead exemption if you wanted to take advantage. Am I correct to say that?
Yep. I mean, you file your homestead exemption over whatever property you want to have it on. So if you want to take it to the next house, yes. If not, you can leave it at the old house. Up to you, whatever makes more sense. Most people, of course, are going to bring it to their primary home.
Okay. Gloria asks here, if one has more than one business, do you ask for financial information on the business that is just that's taking on the title, or would you be asking for all sources of income?
So that's the question that left my mind regarding lending to corporations or LLCs, things like that. Conventional loans, true conventional loans, Fannie Mae, Freddie Mac loans, only lend to individuals. They don't make loans to companies. Okay, it's really important to understand, because I have a lot of investors that are wanting to buy their first property and they want to put it under an LLC out the gate. And that's I look at it, it's complicating the formula a little bit, right? Because it's so much easier. If you have a brand new corporation, you don't have a track record on the corporation. If you don't have a track record on the corporation, it's going to be hard for a lender to validate that that corporation is worthy of lending money to, right? But as an individual, it's much easier. So I think about a more strategic way of doing it is buying the homes under your personal name and then flipping them over into your corporation name. Yeah. So there's two different things which a lot of people don't understand. There's a who owns the mortgage and who owns the deed, right? So you can own the mortgage, but your company can own the deed. Yeah. And then of course, once the corporation has the deed, It can file all the financials on its income taxes, right? If you choose to do it that way and start creating that track record for your corporation or for your LLC, where within time it becomes much easier to go to the lender or bank that does those types of loans and show them, hey, look, here's my financial performance on my rental business or my, real estate company, what have you. So no, conventional loans do not lend to corporations. However, you can deed your house or your investment property over to your corporation afterward.
Yep. And so, Julian, so we're coming short here on the final part of the.
Oh man, I was just
section.
getting warmed up.
So your office number is 346-261-3182.
Yep.
So that you can call or text for information.
Yes.
Your email address is vasquezteam@goalterra.com.
That's it.
Is it okay for people to email you directly to your personal? Your business email.
Yeah. So that is our team email, and it's perfectly okay to send general questions there. If you want to send me a question directly, then it's my first initial, Julian J, my last name, at goalterra.com. So it's really simple. It's jvasquez@goalterra.com. If you want to message me on something very specific or particular to you, feel free. If it's something more general, then email the team, email all of us. And I'm in that email too, so I'm going to get it as well. It's just more people are going to see it.
All right. Well, Julian, we really want to thank you so much for the information that you've provided to the people that were attending today. For everybody else that is not an SBI member, just know that if you go to investorrealestatetraining.com, we have the ability for you guys to sit with us and chat about these particular topics that we have for our up and coming workshops. And also, if you want to follow us, feel free to scan this QR code, follow us on all of the social media platforms, as we always put our webinars, our speakers information all on the platform, so you guys can definitely get to watch Julian again, get his information. But what I have to stress the most is interview the people that are taking time in order to spend with you. Julian, you always sometimes you'll step in to our member sessions that are every Monday and just update them about the current market rates, right? Just keep the people informed. And I think that's such a huge benefit to a lot of SVI members, is that the vendors are proactively keeping you up to speed with the current market. So do you have any closing statements, Julian, that you wanted to make?
The only other thing I would say is anybody that's looking at taking the next step forward, that knows they're on their path to acquiring some long-term rentals, have a conversation with a lender, a lender that knows investor business, that knows business owners, the way they operate, their filing, the way they file and all that stuff, and just open up that conversation. We just recently had a gentleman that came to us and he was a little, intimidated, I would say, by the process. He was a little shy, and we eased him into the process, walked him through things, went through his documentation. He's now pre-approved for like a $400,000 loan. So I would say, I always tell people, start early, right? The earlier you start, the most chance we have of fixing whatever needs to be fixing if the conditions aren't ideal or right for you to get a loan, so that we can prep you, and time is our friend at that point. Once you start going out to look for property, it's going to be too late. You're going to miss opportunities. So reach out to us, whether it's text message, let me know you want to talk, let's schedule a one-on-one. We dive into your situation a little deeper. And if we move forward through a loan application, we don't charge for it. We don't charge anything to the Strata Ventures students for running a pre-approval. You get a free copy of your credit report and a really thorough assessment on what you're going to qualify for, or what we need to work on in order to get you qualified.
And I'm glad you said that, Julian, because one of the things that our SVI members do not have a problem with is on the acquisition side. It's the
awesome.
getting the loan, on getting the asset, locking it down. But it comes to me so many times that the back end, the takeout, and because they haven't met with you or found
Yes.
out what those little issues are, they can't connect those two pieces. So what Julian is telling you of taking that first step of finding out where you are right now, and then knowing that you're going to be able to get to that end result maybe 6 months down the road, it's definitely worth all the efforts you're going to put in between there. So Julian, I want to thank you so much again for your time. I look forward to seeing you. We're on the 25th. We're going to go play a couple rounds of golf. Hopefully it's not snowing in Denver.
Make sure to bring a lot of cash with you, okay?
Okay, sir. And again, everybody that's joining us, just remember every Monday from 6:30 to 7:30, we do bring guest speakers and our vendors to chat with you guys and give you some information. So thank you so much, Julian, for everybody that joined us. Have a good evening, and we look forward to seeing you guys again.
Thank you for having me. I look forward to being back soon, Diego. Thank you all for watching. Bye-bye.